Welcome to all of you, Shiksha 360. And in this session, basically, we will discuss some MCQs on chapter number 29 and 30. So I request to all of you who have not subscribed YouTube channel, please subscribe and let's start our session. This is basically set number 21 of the BFM MCQ discussion. Till now, we have discussed 20 sets, basically live discussion. And till now, we have discussed 263 questions. Clear? This is basically starting from the 264 question we have to start today. So let's start. So first question present on your screens now regarding the duration gap analysis. Clear? Duration gap analysis. Clear? On the basis of that also, we have to discuss today one case study. Clear? One case study also on the basis of that we have to discuss now. So let's start. So what the question says that duration gap analysis means. Clear? What the question says that basically duration gap analysis meaning. Applies the concept of duration to the bank's entire balance sheet. Applies the concept of duration to the entire income statement. Applies the concept of duration to the bank's retained earning. And indicates the difference. Clear? Basically, and last one is basically indicates the difference between the gap, indicates the difference in the gap in the time taken, in the time it takes to collect on loan payments versus the time to attract the deposits. Clear? Attract the deposits. Clear? First of all, here we will discuss some important points regarding the duration gap. So what is the formula of the duration gap? Clear? Duration gap. First of all, we have to calculate the modified duration, weighted average modified duration of the assets, weighted average modified duration of the liabilities. Clear? Only after that we are able to calculate the duration gap analysis. Clear? So basically duration gap analysis overall we can say that it is the concept applies to the duration of the bank's entire balance sheet. So basically in the balance, basically it is basically applicable over the entire balance sheet. Clear? Basically it is applicable over the entire balance sheet. Clear? It includes all the things. Clear? All the assets and liabilities. Clear? So basically it is, we can say that in the journal, basically it is applicable to the entire balance sheet. Clear? Entire balance sheet. Clear? So this one is our answer. Okay, this one is our answer. It is basically applicable to the entire balance sheet. Now move to the next question. Duration gap analysis basically helps to capture. Duration gap analysis basically help to capture. So what is the correct answer? So what is the correct answer of this question? Duration gap analysis basically help to capture effect of basis risk on economic equity, effect of basis risk on NII, effect of repricing risk on economic equity, effect of repricing risk on NI. Clear? On NI. So what is the answer here? What is the correct answer? Basically it is the effect of repricing risk. Clear? Duration gap we have to calculate it. Basically I think many of you are able to remember or not. Basically this topic we have discussed in the chapter number 29. Clear? Chapter number 29, that is repricing risk. Clear? We have discussed as it is a separate part. Okay, repricing risk. Clear? Under that we have discussed the duration gap analysis. Clear? Duration gap analysis. So basically it is the effect of repricing risk on the economic equity. Clear? It is a basically effect of the repricing risk basically on the economic equity. Clear? Basically where we have discussed, basically where we have discussed the maturity bucket. Clear? Maturity bucket. At that time these things we have covered. Okay. So this one is our answer. This is basically effect of the repricing risk. Clear? Basically effect of the repricing risk. Now next thing, a bank has entered. Clear? A bank has entered into an interest rate swap. Clear? A bank has entered into interest rate swap where it pays fixed and floating and receives floating MIBOR. Clear? Basically, bank has to pay fixed. Basically, they will do an agreement. Clear? That we will pay the fixed and you will pay the floating. Clear? As per, like, we can say that basically bank has to pay the 9% fixed interest rate, and other company with whom they have basically do the agreement or interest rate swap agreement, they have to pay, like, we can say that RLR plus 2. Either it will increase or decrease. Clear? Like presently 6.5. So how much they have to pay to the bank? That is 8.5, and bank will pay them 9. Sometimes basically we can say that it is 7.5. So basically they have how much they have paid to the bank, that is 9.5. Clear? But the bank will have to pay the fixed amount. Clear? But the bank will have to pay the fixed amount here. Okay. So the question here is to be, a bank has entered. Clear? So the swap would mature in 3 years. Clear? The swap would mature in 3 years. So this transaction would be bucket for the purpose of interest rate sensitivity as. Clear? As basically one, why I will include this question, because I know that many of the students will go with the option number D. Clear? Because in the book also they have given the same line. Clear? Because they have given the same line, but just twisted the word. Here they have, bank has to pay the fixed and bank receives floating. Clear? In the book basically what they have mentioned, just opposite. That's why I have written here also. Clear? I have written included here also. So interest rate swaps basically could be considered as a combination of short position and long position. The notional of the fixed and floating leg of the interest rate swap could be shown in the respective maturity bucket, basically on the maturity date for the fixed leg, that is basically fixed, and reset for the floating date. Like this one, same question, same type of question will be asked. We have discussed. Suppose a bank receives 5-year fixed and pays floating MIBOR. Clear? Bank here receive a fixed. Clear? Here basically bank will receive the fixed and pays floating. Clear? Bank will receive the fixed and pay floating. So in that case, the fixed leg of the swap basically could be shown as positive into the 5 to 7 year bucket. Clear? In the 5 to 7 year bucket. Clear? So in that case, the fixed leg basically of the swap basically could be shown in the positive 5 to 7 year bucket, and the floating leg basically would be shown as a negative in less than 1 month bucket. Clear? Negative in less than 1 month bucket. Clear? So here, but in the question what they say that basically bank has, this one is bank. Clear? But here bank has to pay floating, sorry, pay fixed, receive floating. Just for the understanding purpose, basically that is the totally reverse of that. That is the totally reverse of that. Clear? So here basically it is a 5-year, and in that place basically it is a 3-year. Clear? This basically floating MIBOR, because they have mentioned basically regarding to the 3-year. Clear? So this one is our answer. Clear? That is negative in the 3 to 5 years bucket and positive in less than 1 month bucket. Clear? And positive in less than 1 month bucket. So this one is our answer. Clear? Because here just what they have to, they have reversed the thing. Clear? Here basically where it pays the fixed. Clear? Basically bank has to pay the fixed. So due to that, just remember that here the reverse is condition, so reverse is our answer. Clear? So reverse is our answer. Clear? Directly same thing they have asked here. Clear? But just in the question we have reversed that thing. Clear? Just reverse that thing. So on the basis of that we are able to answer the question. Okay, many times basically many of the students face these types of issue in the examination. Clear? In the examination, because they are not able to understand what the exactly question says that. That's why I will include point by point that you are able to understand what is the point here. So now move to the next question. Interest obligation of significant values should be, interest obligations of significant values should be factored into the relative time buckets, need to be included in the cash flows, should be closely monitored, or none of the above. Clear? Or none of the above. Clear? So basically interest obligation of significant values, yes, you are right, factored into the relevant time buckets. Clear? Basically it should be factored into the relevant time buckets. Clear? So this one is our answer. Yes. Now move to the next question, 268. Very, very easy question and very, very important for the examination point of view. Clear? So the right of depositor to take back money from a fixed deposit by cancelling it before the original maturity date. Basically, it is an example of clear the right of depositor basically to take back money from a fixed deposit by cancelling it before the original maturity date. Basically, it is an example of liberalization, arbitrage, embedded options, securitization. Clear? That is basically embedded. So this one is our answer. Now move to the next question, question number 269. Please go through the question very carefully. The changes in the interest rates, clear the changes in the interest rates impacts a bank's earning. Clear the changing in the interest rates basically impacts bank earning through changes in its clear basically through changes in its clear impacts a bank's earning basically through changing in its. First one is net interest income. Second one is basically impact market value of equity. We sometimes basically this comes in the form of like MVE. Third one is net worth. Clear? Third one is net worth. Clear? So what is the correct answer? Basically the correct answer is option number D. That is all the above 3 points are correct. Clear? So the changes in interest rates basically impact a bank's earning through changes in its net interest income, impact market value of equity, and net worth. Clear? So all the above points are to be correct. Here's option number D is the answer. Now move to the next question, 270. I will left this question. We'll discuss after some time. Now next, this one, very, very easy question. Just you have to understand what they are trying to say here. So if the leverage adjusted duration gap is 5.86 years, clear? If the leverage adjusted duration gap is 5.86 years. So what is the interest rate exposure? Clear? So here, what is the interest rate exposure? Clear? What is the interest rate exposure? Interest rate risk exposure. First one is the duration gap is positive. Clear? Here the duration gap, if just they are asked, the duration gap is positive, basically indicating that the increase in interest rates basically will lead to a decline in net worth. The duration gap is negative, indicating that an increase in interest rate basically will lead to an increase in net worth. The duration gap is positive, basically indicates that increase in interest rate basically will lead to an increase in net worth. The duration gap is negative, basically indicates that the increase in interest rates will lead to a decline in net worth. Clear? So I think many of you are not able to understand basically what is the duration gap, what is all these things. Clear? What is all these things which we are discussing here. So wait, let's directly move towards the concept. Clear? Directly we will move toward the concept here to understand the things. So what is the interest rate sensitivity in this case? Clear? Basically they have given the one question here. Please try to understand all these things. Clear? If you are able to understand this concept, definitely you are able to understand all the points. Clear? All the questions. Clear? What is the interest rate sensitivity basically in the above case? What they have given: tier 1 capital, tier 2 capital, RSA, RSL, DA, that is duration, modified duration, weighted modified duration of the assets, weighted modified duration of the liabilities. Clear? All these things they have given here. Just we have to solve one by one and try to answer the question. Clear? These types of question you will also find in the book. Clear? Basically on page number 598. Clear? Basically they have given one example, but they have not explained well. Clear? So here we will discuss one by one all the points. So what is the interest rate sensitivity ratio? Clear? First of all, we have to understand. Sometimes basically they are asking positive gap. Positive gap or negative gap. Okay, so what is positive gap or negative gap? Clear? Positive gap is to be known as asset sensitivity gap. Positive gap, it is to be known as asset sensitivity gap, and negative gap, that is basically known as liability sensitivity gap. Liability sensitivity gap. Okay. Positive gap is to be known as asset sensitivity gap. Negative gap is to be known as liability sensitivity gap. So when there is to be positive gap, that is basically when we have more assets than the more liabilities. That is RSA minus RSL, that it is to be greater than 0. That is positive gap. And when it is to be negative, that is RSA minus RSL less than is equal to RSL less than is equal to 0. Clear? that is to be negative gap. Clear? That is to be negative gap. Okay. So now let's discuss here in the question what they are asking. Interest rate sensitivity. Clear? So basically how we can calculate the interest rate sensitivity. Clear? Interest rate sensitivity, basically it is to be represented by the W. Clear? In the formulas, basically when we will discuss interest rate sensitivity, basically it is to be represented by the W. So IRS or W, what is W? It is equal to RSL upon RSA. Clear? Interest rate sensitivity ratio. Clear? Interest rate sensitivity ratio. Clear? What is W? Basically W is basically, we can know that RSL upon RSA. Clear? W is basically what? RSL upon RSA. And here we have to calculate the interest rate sensitivity. So please tell everything they have given here. 18590 upon 18, sorry, this is the W. Clear? This is the W, and interest rate sensitivity, that is RSA upon RSL. Clear? Basically we have to measure with the asset to liability. Clear? Basically we have to measure with the asset to liability. Clear? And what is asset here? 18251 upon RSL is equal to 18590. 18590. Clear? RSA upon RSL. So please tell 18251. 18251 divided by 18590. So clear? So it comes out to basically 98. It comes out to basically approximately 98.17%. Clear? 98.17%. So this one is our answer. Okay, so this one is our answer. Clear? That is RSA upon RSL. Clear? RSA upon RSL. Interest rate sensitivity. Now move to the next one. What is the weight in the above case? Clear? Here they have given the interest sensitivity ratio. Clear? Please remember, when they are asking the interest rate sensitivity ratio, that is to be RSA upon RSL. Clear? Please remember these things. Clear? When they are asking basically interest rate sensitivity ratio, this one is the formula RSA upon RSL. And when they have asking the weight, that is basically RSL upon RSA. Clear? When they are asking the weight, that is RSL upon RSA. Clear? Please remember both these things. Clear? In the examination, basically you will get both these types of questions. So interest rate sensitivity is equal to RSA upon RSL. And what is the weight here? Weight, we know that basically it is to be RSL upon RSA. So 18590 upon 18251. 18590 divided by 18521. So 1.003. Clear? 1.003. Clear? So we can say that this one is to be our answer. Okay, so this one is to be our answer here. Okay. Now next one here, we have to calculate the modified duration gap. Next point which we have to calculate here, that is modified duration gap. So what is the formula of the modified duration gap? Modified duration. So modified duration gap, it is equal to the dA minus W into DL. Clear? dA minus W into DL. Clear? So we know that W is here, basically what we have, W is equal to 1.003. This is the value we have calculated of the W. Clear? W, basically how much we will get here? W, that is 1.003. The value of the W we will get here. Or we will approximately, it has to be option basically 1.02. Clear? So we will write it as 1.02 W. So just put the formulas. dA they have given, DL they have given. dA, what is the value of dA? That is 1.96 into 1.02 into 1.25. So please tell fast what is the answer here. So 1.96 minus how much we have to minus? 1.02 into 1.25, that is minus 1.275 minus 1.96. So 0.685, clear, 0.685 we will get here. So approximately this one is our answer. Okay, approximately this one is our answer. Clear, you will get these types of case study directly in the examination. Very easy questions, clear, very easy questions every time. You will get these types of question in the examination. Just what you have to in the examination or at the time of examination, you have to remember the question. Clear, you have to remember the formula and how to solve. Clear, just please keep one example in your mind. Like in this way, basically we will go one by one. Clear, we will go one by one. Clear, definitely you are able to move towards answer. Now move to the next question, that is what is leverage ratio. What is a leverage ratio? So leverage ratio basically is equal to RSA plus tier 1 plus tier. Leverage ratio is equal to RSA into tier 1 into tier 2. Clear, into tier 1 into tier 2. Clear. So RSA, we know that basically what is RSA 18251. Sorry, RSA upon. Sorry, RSA upon. Same thing they have given. RSA is equal to 18251 upon tier 1 plus tier 2, 700 plus 650. So 18251 divided by 700 plus 650 divided by 1350. So it comes out to basically 13.519. So basically we will approximate 13.5. So this one is our answer. Clear? So this one is clear. So basically all this, basically it is an illustration of the basically repricing risk. Clear, repricing risk or calculation for the modified duration gap. Clear, modified duration gap. And I will write here once again all the formulas so that you are able to remember the things. Clear, so that you are able to remember the things. First of all, we have to calculate the, if they are asking interest rate sensitivity. Clear, this one is the, like this one, interest rate sensitivity ratio. Clear, interest rate sensitivity ratio. This is a different thing. So what we have to do, RSA upon RSL. And second one, if they are basically running W, that is RSL upon RSL. Clear, W is equal to RSL upon RSL. Next one is, what is the question, that is modified duration of gap. Modified duration gap, it is equal to the DA minus W into DL. Clear, DA minus W into D. W we know that RSL upon RSL. And next one is, this is modified duration gap. Next thing which sometimes basically they are asking, this is to be known as DGAP. Clear, this is to be known as DGAP. Clear, this is to be known as DGAP. Next one is modified duration of equity. Clear, sometimes basically they will ask these terms directly. Modified duration of equity. So what is modified duration of equity? Basically it is equal to DGAP into leverage. DGAP into leverage. So here we know that DGAP, that is DA minus W into DA. But we know that what is leverage? Is equal to RSA upon equity. Equity, what is mean that tier 1 plus tier 2. What is equity here? That is tier 1 plus tier 2. Clear? So in this way, you have to remember the formulas and apply on the questions. Definitely you will get straightforward questions. Clear, straightforward question in the examination. No need to worry anything regarding that. Okay, just they will give the values here. You have to put the values in the formula and try to answer the question. Clear? Very easy type of question if they will ask this type of question in the examination. Clear? Never, you will never consider that this is a case study or typical. Clear? Easy question. What the main thing is that you have to remember the formulas. Now let's discuss these two things, 272 and 273. So very little difference between these two questions. RBI has considered it appropriate to enhance guidelines on IRRBB. Clear? RBI has considered it appropriate to enhance guidelines on IRRB. Clear? So IRRBB. So first of all, there is one question, that is, can anyone tell what is the full form of IRRBB? Interest rate risk in banking book. Clear? Interest rate risk in banking book. Clear? Please remember these things. If you remember these full forms, only after that you are able to answer what their questioning is. Clear? What the question is. And what it says, that basically RBI considered it appropriate to enhance guidelines on IRRBB governance and measurement, and has a circulated draft guidelines for comments from scheduled commercial bank. Clear? Basically when they will do this step. Clear? From commercial bank, 2nd of February 2017, that is basically they have to do comments. Clear? Basically from the scheduled banks, circulated draft guidelines, basically not exactly, basically just we can say that we have to implement these types of things. Clear? We have to implement these types of things. Okay, we have to implement these types of things for comments from the scheduled commercial bank, 2nd of February 2017, 23rd of February 2017, 15th of February 2018, 1st of April 2017. Clear? So basically when they have drafted these guidelines from scheduled commercial banks to basically for comments, that is from 2nd of February 2017. Clear? From 2nd of February 2017, this one is the answer here. Next question, one more thing. Banks are required. Clear? Basically when the banks are required to implement enhanced guidelines on IRRBB governance and measurement. Clear? Here they have given the draft guidelines. Clear? Draft guidelines, basically you will remember that in the 2017. Clear? 2017, that is 2, that is 2nd of February. Clear? 2, basically please remember, 2 is date also, 2 is month also. Clear? When they issue the draft guidelines, just you have to remember that 2017. Clear? Here 2 is the date, 2 is the month, 2nd of February. Okay, and when they have to implement, banks are required to implement the enhanced guidelines on IRRBB governance and measurement, basically from they have to implement basically from 1st of April 2019. Clear? Basically they have to implement from 1st of April 2019. Clear? They have to implement from basically 1st of April 2019. Clear? So this one is our answer. Okay, so please remember, when they have to draft guidelines, basically draft the guidelines, basically to comment on the drafter guidelines, basically 2nd of February 2017. And when they have to implement the enhanced guidelines, 1st of April 2019. Clear? Please remember both these points if you will get question in the examination from these 2 points, so you are able to answer the question correctly. Clear? Without any facing difficulty. So please tell these 2 questions and this case study, it is clear to all of you or not? What I have discussed here, please respond fast. All the points are clear to all of you? So now let's discuss this question. So this question and this question for practice purpose. Clear? Question number 270 and question number 271, basically for the practice purpose. In the evening, I will discuss some more questions on this chapter. Clear? Along with some important points. Clear? Because this chapter is very, very important and easy for the examination point of view to score the questions. Clear? To score the marks, sorry. So I will post some questions also in the group in the evening so that you are trying to solve. Clear? 5 to 10 questions I will post after the session. Clear? So that you are able to understand the concept. So please do revision of topic wise. Clear? Whatever I have shared in the group, please do revision. Clear? So that you are able to understand. Clear? So in the regular sessions, I have posted videos of these chapters. Please go through the videos. Only after that you are able to remember the concept. Clear? Only after that you are able to remember the concept. So thanks to all of you for joining this session. In the evening, we will discuss some questions, these 2 questions along with some other question and one case study. Clear? One case study, so that you are able to understand the concept with the help of questions. Clear? Here we have 2 questions left. Question number 260 270 and 271. Clear? We will discuss both these questions in the evening. In the meanwhile, you will try to understand what these questions say. That clear? Along with some more questions and 1 or 2 case studies. So thanks to all of you for joining this session.